Imagine losing $2 billion in a single scam. That's the staggering amount lost in India's biggest stock market fraud. The scale of stock market scams globally is truly shocking. From Wall Street to the Shanghai Stock Exchange, countless investors have been duped out of their hard-earned money. Now let's narrow our focus to India, a burgeoning economic powerhouse with a rapidly growing stock market. This growth, however, has not been without its pitfalls. The biggest of these is undoubtedly the $2 billion scam that rocked the nation. This wasn't a simple case of a few investors losing their money. No, this was a scam that affected countless individuals, shaking their trust in the very institution meant to safeguard their investments. Now let's dive into the details of this colossal financial disaster. This is not a story from a movie script, it's a real-life financial thriller that played out in the Indian stock market. Let's travel back in time, to when it all began. In the early days, our scammer was an unknown entity, just another face in the bustling crowd of the stock market. But as we know, appearances can be deceiving. With a calculated mind and an insatiable ambition, the scammer began to rise through the ranks, leaving a trail of manipulated stocks in their wake. The scammer, like a chameleon, seamlessly infiltrated the stock market. They mastered the art of disguise, blending into the chaotic world of stocks and shares, all while manipulating the market from within. Their tactics were simple yet effective: play the market like a game, exploit its weaknesses, and reap the rewards. The scammer's rise was meteoric. From an unknown player to a market mover, they had the market dancing to their tunes. Their strategy: pump and dump. They would inflate the prices of certain stocks, creating an artificial demand. The market, oblivious to the manipulation, would follow suit, driving the prices up. And just when the prices hit the peak, the scammer would sell, making astronomical profits while leaving others to bear the losses. But every house of cards is destined to fall. It was only a matter of time before the irregularities started to surface. Some sharp-eyed market watchers began to notice the unusual trading patterns. The same stocks were repeatedly hitting the high and low thresholds, and the volumes were abnormally high. The puzzle pieces were starting to fit together, and the picture they formed was not pretty. The authorities were alerted, and an investigation was launched. The probe revealed a web of deceit and manipulation spun by the scammer. The invisible puppeteer was finally unmasked. The scammer's game was up. The stock market, once a playground for their nefarious activities, had turned into a crime scene. But by the time the scam was discovered, it was too late. The scammer had already made off with millions, leaving a trail of financial destruction behind. The market was rattled, investors were shaken, and the faith in the system was severely dented. The scam was now out in the open, but the damage was already done. The fallout was catastrophic, and the repercussions were felt far and wide. The immediate aftermath of the scam was marked by significant financial losses. Investors, many of whom had put their life savings into the stock market, were left in financial ruin. The market itself took a hit too, with the Sensex plummeting sharply, eroding billions in market capitalization. The ripple effects of this financial debacle were not just limited to the market or individual investors, it had wider implications on the economy as a whole. The faith in the Indian stock market was shattered, foreign investors became wary, pulling out their investments, leading to a sharp decline in foreign direct investment. The scam also brought to light the glaring loopholes in the regulatory framework. It exposed the lack of transparency, ineffective oversight, and weak enforcement of rules that had allowed such a massive scam to go unnoticed for so long. This led to a much-needed overhaul of the regulatory system. The Securities and Exchange Board of India, or SEBI, was given statutory powers to protect the interests of investors and to regulate the market. As for the scammer, the fate meted out was severe. Legal proceedings were initiated, and after a lengthy trial, the mastermind behind the scam was convicted. The court's decision sent a clear message that financial crimes of such magnitude would not be tolerated. However, the scars left by the scam ran deep. It was a stark reminder of the risks inherent in the stock market and the devastating effects when things go wrong. Despite the regulatory changes and stricter enforcement of rules, the question remains. This was a wake-up call for regulators, but was it enough to prevent future scams? Every disaster brings lessons, and this scam was no different. In the aftermath of the turmoil, the financial industry and its watchdogs were left with some crucial takeaways. They serve as a potent reminder that failure isn't the end, but a stepping stone to greater understanding and prevention. The first lesson was the importance of regulatory oversight. Financial markets need a strong and vigilant regulator to ensure that all players abide by the rules. This scam illuminated the gaps in the system, revealing that oversight was not as robust as it needed to be. It was a wake-up call for the authorities to tighten their grip, to close the loopholes, and to enforce stricter accountability. The second lesson was about the dangers of unchecked power. The case of the Adani Group and the coal block allocations was a stark reminder that power without accountability can lead to disastrous consequences. When entities gain too much influence, they can manipulate the system to their advantage, often at the expense of others. Therefore, checks and balances are vital to curb such practices and maintain the integrity of the financial markets. Finally, the event underscored the urgent need for investor education. Many investors were caught off guard, their dreams shattered and savings wiped out. This incident highlighted the risks inherent in the financial markets and the importance of understanding these risks before investing. It served as a reminder that knowledge is power, and that power can help protect one's hard-earned money. In conclusion, the scam served as a stark reminder of the importance of sound regulation, the danger of unchecked power, and the need for investor education. They are critical lessons that should resonate not just within India, but with investors across the globe. These lessons are not only for India, but for all investors worldwide. This $2 billion scam was a dark chapter in India's financial history, but it also led to significant reforms. As we've seen, the scale of this fraud was staggering, shaking the very foundations of the country's financial market and leaving a lasting impact on its economic landscape. This was not a simple case of manipulation. It was a meticulously planned and executed operation that exploited the vulnerabilities in the system. The scam was a masterclass in deception, involving a web of complex transactions, secret contracts, and illicit coal block allocations. The aftermath was equally dramatic, with the cancellation of leases, the implementation of new regulations, and the promise of a clean and transparent regime. However, the scars from this scandal run deep. The aftermath has been a period of intense scrutiny and reform, prompting a reevaluation of the country's financial regulations. The scam served as a harsh reminder of the dangers of unchecked power and the importance of transparency in financial dealings. It also highlighted the need for a more robust regulatory framework to prevent such scams in the future. But it's not all doom and gloom. The fallout from the scam has also led to some positive changes. The call for transparency and accountability has grown louder, and the government has taken steps towards implementing more stringent regulations. These reforms, although born out of a scandal, are essential for the country's financial health and the protection of its investors. In the end, this dark chapter in India's financial history serves as a stark reminder of the importance of vigilance, transparency, and accountability in the financial world. It's a lesson that we all need to take to heart, whether we're investors, financial enthusiasts, or simply concerned citizens. If you found this video informative, please share it with others, and don't forget to subscribe to our channel for more insights into the world of finance and investing.